Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, markets soft the last couple of days, the Dow plunging over 500 points today. What's causing the big sell-off?
Yeah, very sharp moves in the broad equities today, especially in the U.S. And through Europe as well. I think the catalyst, to call it that, on this recent move was the U.S. Manufacturing PMI number that we got in yesterday morning. That came in much softer than expected. We were looking for a bounce back and something above 50 on the PMIs, which shows that the sector's growing. Under 50 is contracting. And we had a number that came in that we hadn't seen really since the financial crisis. So to be near a decade low on that number just reinforced, I think, the thought or the narrative that we're heading into a recession. Now, if that number was in a bubble, in a vacuum all on its own, would it have caused this sort of move? You know, I don't think so. But again, it's the narrative of people worrying, are we going into a recession? You hear everywhere about slowing global growth. Then add on that U.S.-China trade war issue, and people are getting worried. And again, now we're rolling into October. And of course, fresh on people's minds is what happened last October with the sell-off in October, some steadying through November, and then the capitulation lows that we saw around Christmas time in December. So the mindset or the investor psychology, I think, is susceptible to be worried, and when you see that, you can see the market, sell off in a rather sharp manner, like we're seeing today. And again, you kind of go through the year-to-date numbers, which look great, again, coming out of the December sell-off from last year. But we were, a stone's throw away from all-time highs, so people are maybe more willing to take risk off the table, and once selling starts to happen, that really compounds on itself, and you can get some pretty sharp moves like we've seen in the last 2 days in the market.
Given all the issues facing the market, are we looking at a sell-off similar to last fall?
Yeah, just as I was saying, I mean, there's a lot economically that people are looking at. You've got Germany especially, I think, looking like they're going to go into a recession, may already be in a recession. And one thing I would point out is the manufacturing PMI number that we got yesterday is important in the United States, but it is hugely important in Germany, and their manufacturing PMI has been trending down since the beginning of 2018. So it's been a pretty steady down move for them, and their manufacturing sector makes up roughly 70% of their GDP. Now, the U.S. manufacturing side makes up about 11% of the U.S. GDP. So it means two completely different things to each of those countries, and I think that's an important thing to keep in mind. The U.S. is much more consumer-driven, so we will be getting the non-manufacturing PMI tomorrow morning that I think will really have the market's attention. But again, that's sort of the hard economic data that we're seeing coming in. There's the trade data that we really don't know how that's going to go. We're going to have those negotiations start again at a higher level next week with the Chinese. They're on holiday this week. So again, do I think it's going to get done in a heartbeat? Absolutely not. But if the markets starts to sense that maybe there's some common ground being reached. I mean, we have seen the Chinese buying more agricultural products, and we've seen that show up in some of the egg prices, as well as some weather-driven events there. But we also have the Trump impeachment issue going on, and that again just sort of goes to the sentiment in the market that there's a little bit more caution out there than maybe there would be otherwise. So it's a number of forces acting on the market, and again, I think that people reminding themselves of what happened last fall, it makes that sentiment maybe a little more brittle than it would have been otherwise. So I still think that things are looking okay. We've had some what the Fed described as cautionary or mid-cycle adjustment rate cuts. You see easing coming back in through Europe. So the central bankers know that things are slowing and are trying to get out in front of it. And given that the strength of the U.S. economy based more on the consumer data has been fairly strong. The housing data, with the move lower in rates, has looked stronger as well. So to me, the U.S. economy still looks more robust than globally. So I think there is a slowing for sure, but I don't necessarily get the sense that we're going to see the type of move or the severity of the move that we saw last fall. And it's key to remember that the Fed was tightening into last fall, where they've got an easing bias going into this fall. They've already cut rates 50 basis points to 25 basis point moves. And right now, again, given the market move of the last 2 days, the market's all of a sudden screaming for there's about a 50-50 chance of another 50 basis points by the end of the year. So we've got 2 meetings left, so that would mean a 50% chance of a cut at each of those. So the market is pricing in more easing, which again I think should be supportive of asset prices of the financial indices. So I don't think it gets as bad as last year. I think this is, again, sort of a readjustment as we get some slowing. But I think with central banks being much more supportive this year, that things don't get as bad as they got last year.
We'll have more with Drew Zimmerman right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, with all the uncertainties, do you see gold moving to new highs?
Yeah, this has been a great environment for gold all through the sort of mid-year period. Gold performed exceptionally well, moving from below 1,300 to over 1,550. But I think we may have run into a bit of resistance on the gold front. This is still, a good environment for gold when you look at all the different uncertainties out there and slowing global growth. And I think maybe more importantly is, the lowering of interest rates globally and in the United States. As interest rates go lower, that's more incentive to own gold, and should, and heaven forbid, U.S. rates ever get or go negative, that is a big incentive to own gold. Then it doesn't cost you anything to own gold, so you're outperforming immediately as soon as you buy gold versus a bond that would normally pay you a coupon. But again, if it goes negative, it takes that away. So to answer that question correctly, I would have to say in the near term, I'm thinking gold is a little overdone. When we look at the speculative positioning, the speculators are about as long as they ever have been of gold. And, my view on that is it's never a direct timing tool, but higher prices are always set at the margin. And when you've got the most people long gold that have been long gold, it's harder for that marginal person to come in and set prices higher. So I think there's room for a little further pullback in gold. Again, it's going to get supported if we do see equities selling off, but I think you could look at a retest maybe of the, call it 1400 area of gold would be, I think, a better place for some of the longs that are in gold to get out, and that would give it some more energy for a move up over the medium term. And I do think that there's a lot of reasons to be long gold in the years ahead. So again, answering that question with sort of two different time frames. Near term, I think, again, a rising U.S. dollar will create some pressure, and I think a possible setback here with rates. I do think rates could move a little bit higher near term. I think if this equity market doesn't continue to sell off the way it has the last 2 days. But again, I'm not looking for anything as severe as last year. So I do think that this pop back above 1500 might be a near term sell in gold. But again, I'd be looking to get long of gold on a bigger pullback for the medium term of the next couple of years.
We'll have more with Drew Zimmerman right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Drew Zimmerman. Drew, the oil market has had a huge move down over the past few weeks after the attacks on Saudi Arabia. Where do you see oil prices going from here?
Yeah, I've been surprised at the severity of the pullback in crude after the attack. So when we gapped open and traded over $63, I thought there would be a renewed risk premium that would stay in crude oil that should give crude oil at least a few dollars of a higher bid than where we'd been on that Friday. So I thought we would likely see that $55 level be a pretty solid floor in crude prices going forward, just as the ongoing risk in the region and the knowledge that that type of attack can happen and seemingly happen quite easily without being detected would leave a risk premium in the market. However, from those highs we're off over $10 in the last 2 weeks. It's been a very sharp move down, and it's been a confluence of oil-specific things with the way that Saudi Arabia was able to maintain shipments to customers with oils that they had in supply, as well as bring back other production online very quickly and start the repairs to the facilities that were damaged quite quickly. And I think it took Saudi about 11 days to get back to pre-attack production levels, which was maybe much faster than the market thought was going to happen. Then on the geopolitical side, we didn't have any retaliation either immediately or in the past several weeks, it's been a very quiet sort of period. There hasn't even really been a war of words, even let alone anything more severe happening. So a severe de-escalation or a rapid de-escalation of what was thought could be a real spark plug that was just going to make things worse. So as that de-escalated, that really took some of the risk premium out of the market. And then again, as we've kind of gone the way of the stock market the last couple of days, both the U.S. PMI number and again global PMIs showing the manufacturing side of the economy is really slowing, global trade slowing. Again, the ongoing trade issues that are sort of scaring the market a little bit. So you sort of had a confluence of events giving a very bearish outlook for crude oil in that, the supply side wasn't going to be disrupted like it could have been. And then on the economic side, really taking the prospect of demand from firmer global growth lower as well. So everything really sort of came at crude over the last 2 weeks. It's been sold quite aggressively down to a low just under $52.50 today, really nearing the lows that we had been at throughout this summer period. So some critical levels in crude. I am thinking that the last 10 days, I think we're 10 days down in a row now on crude oil, have maybe given us a firm enough push to the downside that these price levels, this area, should be supportive of crude. But again, when crude oil does move like this, we've seen it at times in the past, it can go further than what you think makes any sense. So I want to be cautious of that, but at the same time thinking that, we're a little extended on the downside in the immediate term. Again, this is going to tie into what's going on globally. If equity markets were going to continue to sell off, again, we saw what crude did last fall when the equity market was falling, because again, that demand side of the crude oil equation is going to be hugely dependent on how the market perceives global growth, the trade issues with China, and again, the manufacturing side of the economy. So really all tied into one there, but I am thinking that we are maybe a little oversold near term on crude, and think we could expect a bounce. And then just to preface it with, I do still think there should be maybe a firmer risk premium in the crude price, even though, the U.S. production levels are high enough where, on paper, the U.S. could basically be self-sufficient. That's not quite how the oil market works with all the infrastructure in place. So I do think there should still be a higher risk premium in crude oil and even in the WTI price, because it's based in North America isn't sort of safe from what's happening throughout the Middle East. So I think there should be a premium coming back in there. I think it's getting oversold at these levels, but still approaching it cautiously at this point.
Canadian dollar has stayed relatively stable lately compared to the U.S. dollar. Where do you see the Canadian buck going ahead?
Yeah, the volatility in the Canadian dollar has been very, very narrow. I mean, a sharper down day today, but I mean, if you look back at the last 2 months, we've largely been in a 1 cent range in the Canadian dollar and sort of a year-to-date range of only a few cents. So I've spent some time looking at that. I mean, I believe there's always a few key drivers of the Canadian dollar. Crude oil is going to be a key input there. The interest rate differential between Canada and the United States is usually a very closely correlated driver of the Canadian dollar. But taking the interest rate differential, for example, is we've had a huge move in the interest rate differentials on the 2-year notes. For example, you can actually get a higher premium for Canadian dollar, or a higher interest rate, I should say, on Canadian 2-year paper than U.S. 2-year paper. And it was really only half a year ago that was definitely not the case. It was a much higher premium to be in U.S. short-term paper. So I think there's been a lot of global flows into Canada and the U.S. dollar, because both of the currencies have been incredibly strong year to date. So I think we're seeing a very low volatility in the Canada-US exchange rate because the same drivers are moving both currencies. Both are stable governments. Both have relatively high-yielding, safe sovereign paper for international flows to go into. So I think those drivers are making both currencies stronger than a lot of the other currencies in the world right now. Where I see a risk for the Canadian dollar is the Canadian dollar, I think, has really been supported in the narrative that the Bank of Canada is not going to have to cut rates. Even in our interest rate probabilities, as I was saying, there's a 50% chance the Fed's going to have to cut 50 basis points by the end of this year. We have about a 25% chance that the Bank of Canada will cut once, or 25 basis points by the end of this year. So still a much more hawkish view on the Bank of Canada. If that narrative has to change, that is, if we start getting some softer economic data in Canada, maybe we end up with another oil shock like we had last fall, or obviously the big oil shock that really spurred the Bank of Canada into cutting rates back in 2014, or just our other economic data. I mean, we just had the last GDP print for the month come in flat instead of positive. So if things are looking to be slowing, then the Bank of Canada would be more likely to get out in front. And again, I think the key thing here is the Bank of Canada is one of the few of the developed banks worldwide that has raised rates at any of their last movements, where all of the other central banks seem to be cutting rates at this time. So Canada has really been a standalone on that front. The risk to the Canadian dollar here at 75.5 cents is if that narrative starts to change. So I think that's key for people to watch. Keep your eye on the domestic economic data. But again, anything out of the central bank will be key to watch, because if they start to change their tone and start to sound like they're going to, do what all the other central banks of the world have been doing, then we've lost a little bit of that edge that has been keeping the Canadian dollar so strong. So I think there's much more risk to the downside in the Canadian dollar than there is to the upside at this point.
Drew, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.